Hi everyone, so in this lesson we're going to focus on the multiplier. Now this is a really important concept in macroeconomics. It will help develop your understanding of the circular flow of income as we've already seen so far, but also to improve your understanding more generally of aggregate demand. Okay, so let's take a look. So the multiplier measures the extent to which an injection into the circular flow of income generates a larger effect on the level of income within that circular flow. So, for instance, if you consider government spending, additional government spending taking place to build perhaps hospitals or schools or roads, well, what might be the actual impact of that additional spending? Well, the first thing is likely to mean that various firms are going to benefit from additional income, additional revenue. This will also help to generate employment for those firms because they may well need to increase the capacity to be able to perform various jobs, and therefore they recruit more staff. That will help to boost incomes, of course, and consumption will increase. As those staff then can consume more, those new recruits for those firms, it means that there will be further consumption spending. That additional consumption spending will generate additional revenue, and so on and so on. So that really is the notion of the multiplier. Okay, so we're going to look at a numerical example as to how you might see this appear in a multiple choice style question. But before we do so, it's really important that you understand one of the key influences of the key influence perhaps in terms of the size of the multiplier is really the marginal propensity to consume. And the marginal propensity to consume is influenced by those withdrawals, savings, imports and taxation. So yes, we need to understand these areas. So let's take a quick look at the marginal rate of taxation. Now, the marginal rate of taxation is simply the proportion of any income change paid in tax. So if your income changes, how much does tax actually change on that additional income that you have now earned? So the marginal rate of tax is an important concept, as we'll see when we look at fiscal policy. But if incomes rise and you're actually being taxed far more heavily, then of course that can be bad news in terms of the size of the marginal propensity to consume. Okay, now we've also got the marginal propensity to import, of course. The marginal propensity to import, well, we know imports are another leakage or withdrawal from our circular flow of income. And here, well, this simply measures the proportion of any income change spent on imports, okay? So the proportion of any income change spent on imports. So the marginal propensity to import equals the change in imports divided by the change in income. Okay, nice and straightforward. Now, last time we also looked at the marginal propensity to save, and that was simply how a change in income would give rise to a change in savings. It all depends how consumers react to these different changes, whether they choose to actually import more from abroad, i.e. buy or consume goods from abroad, or whether the government actually has policies which will take more of their income away and therefore not necessarily give rise to a big increase in consumption. Okay, so what does all this mean? Well, when we put all of these areas together, the marginal propensity to save, the marginal rate of taxation, the marginal propensity to import, it means that we can also generate the marginal propensity to withdraw. Okay, so this is the total, the sum total of the marginal propensity to save plus the marginal rate of taxation and the marginal propensity to import. Okay, right, so why is this so relevant? Well, as I said, it's really relevant so that we can understand how we calculate the multiplier. Now, I've put here MPW, and of course that stands for our marginal propensity to withdraw. So that is the sum total, of course, of MPS, MRT and MPM. Okay, right, so K is our multiplier. So this is the actual multiplier, and we can see that the multiplier equals 1 over 1 minus MPC. Or alternatively, 1 over MPW, the marginal propensity to withdraw. Okay, so let's just take a little example. I've put down here that we've got a marginal propensity to consume of 0.6. Okay, so 0.6. Now, this is the sort of question that you might face in an exam. Now, they tend to use closed economy examples with a financial sector. So there tends to be some savings taking place within the model that's often used in multiple choice questions. So let's have a little look at how this would actually work out. So if we work through this first example, we can see we have 1 over 1 minus 0.6. Okay, so 1 over 1 minus 0.6. So of course this would translate to 1 over 0.4. Okay, right. Now if we just have a look at the actual MPW, well, if the marginal propensity to consume is 0.6, then the marginal propensity to withdraw will be 0.4. Okay. Now you can see it adds up to 1, because that is the total increase in income, of course. So the total increase in income, some of it is gone to withdrawals, be it tax, be it savings, be it imports, but some of it is being consumed, and that is at a rate of 0.6. So therefore we can see that this will translate to 1 over 0.4. So we end up with exactly the same philosophy here, and we can see that we end up with a multiplier which would equal 2.5. Okay, so what does this mean? Well, it means that perhaps we see 100 million in additional investment that's undertaken within the economy. So that's 100 million there of injections that have taken place in the economy. So the aggregate demand curve now shifts as so, out to the right. Aggregate demand for the economy would increase. But due to the actual multiplier effect, we would see an additional increase of 250 million. Okay, so we can see that denoted there. Okay, so there's an additional increase due to the multiplier. Aggregate demand increases further than we first thought it actually would, and that is due to the multiplication effect of these injections throughout the circular flow of income. Right, okay guys, we'll come back to this later on in the course, because it's really very important when it comes to any of these injections, and of course these injections are components of aggregate demand. Okay, we'll leave it there though. Thanks guys.